Budget tomorrow night will focus on the cost of living. There'll be wage rises for childcare educators and also for aged care workers. They'll be spending on some form of energy cost relief. That's all the speculation. Then, of course, there are the revised Stage 3 tax cuts that will cost around $25 billion just in year one and then ongoing. It's all about alleviating a political pain point for families and also the government ahead of the federal election next year.
Cost of living really is the biggest priority in the budget. We know that you're under the pump, we know you're under pressure, and we're trying to help where we can in the most responsible way.
But the Treasurer, Jim Chalmers, is likely to show, despite the spending, inflation falling to between 2 and 3% by as early as December this year, paving the way potentially for interest rate cuts if that were true. The Reserve Bank by then expects inflation, headline and underlying, to still be at 3.8%. Now, one important question here is whether the government's own subsidies will temporarily and potentially artificially cut the inflation rate. If the government cuts the price of energy, or as it has in the past, childcare, it will diminish our inflation rate. The problem occurs when that temporary support disappears and inflation for those items comes roaring back. So let me put all of that to Warren Hogan, independent economist and a consultant with the small business lender Judo Bank. And he'll be with us, of course, for our budget coverage from Parliament House, Canberra tomorrow night. Warren, I just want to go to that point there because government, Treasury, if they know what's in the budget already, they could start suggesting themselves, giving some hints that this could bring about a fall in inflation.
Yeah, hi, Ross. Yeah, no, well, that's exactly the implication of such a big difference in what the government released to the media overnight for inflation and what the RBA told us their view was last week and what is generally the market view. So there has to be some significant measures in the budget which will push down the measured inflation rate. As you said before, an artificial reduction in inflation because it's only temporary, and the act of putting money into people's pockets to pay their electricity bills or part of their rent is actually an act of putting money into the economy and will potentially make the RBA's job harder by boosting demand.
Okay, so I want to show people just one example of this. I've shared this with you earlier, and that is going back to 2020. Of course, this government wasn't in power. It was Josh Frydenberg who was the Treasurer. Now, you can see here in June 2020 in that quarter, a massive fall in the inflation rate. It fell to minus 1.9%. In other words, prices going backwards. But the reason for that was because of a temporary policy by the government of the day to make childcare free of charge for a period. So something as simple as saying, OK, childcare is free of charge, we'll subsidise it, can have that type of an impact on the inflation rate. If that were the case, the argument from government to the Reserve Bank would be, well, hey, you don't need to do anything with interest rates here. You can even cut them if you like, because have a look at what we've done to the inflation rate.
Yeah, and I don't think the RBA will buy that argument. The RBA obviously has a team of economists trawling through this data forensically. And in fact, what they're trying to do is just to find out what the underlying inflation pressure in the economy is, because this focus on measured inflation with the government's forecast for the CPI is actually not what the RBA is trying to do. They're trying to understand what the inflation pulse is and, of course, whether or not there's a risk inflation is going to get stuck in our economy. So even if we do get such a significant drop in inflation over the next 3 or 4 quarters, as the government forecast suggests, there certainly won't be a mechanical response from the RBA to either not lift rates if the economy is doing better than expected, or indeed cut rates if the economy looks a bit softer, but their assessment is inflation's actually higher than what the CPI says.
But I can't work out one other thing about this here, Warren. Try and explain this to me. If the government, via the Stage 3 tax cuts, is going to pump in more than $20 billion of cash into the economy at July 1 this year, and that money presumably is going to be spent very, very rapidly, how can that not be inflationary? How can companies not think that they'll put their prices up? How can that not certainly add to the inflationary pressures that Australia is currently experiencing?
Well, I think that's right. I mean, the response from the RBA and the Treasury will be that, well, we've known about these tax cuts, even in their new form from earlier in the year, and we've factored that into our forecasts and our policy thinking. But the reality is economic forecasting is an imprecise activity. Even in pre-pandemic times, it was difficult, but the economy now is absolutely diabolical to forecast. We've seen the errors that the Treasury, the RBA have made in recent years, and private forecasters. And of course, we must wait and see what the actual tax cuts do to the economy come 1 July, which of course might be different to what they expect. So that big tax cut of $24 billion plus the other additional cost of living measures potentially is going to give the consumer a bit of a boost in the second half of this year. And that, I think, is going to be inflationary.
Okay, but to justify the rising debt and spending that the government has got, it's got to get the economy to speed up much more quickly. Now, it's trying to do so with all sorts of stimulus for business in this budget, apparently, and actual stimulus into the energy transition. So, but that in itself, again, could create more inflation, keeping the interest rates higher.
Yeah, well, I think the focus on the next year is all about the pre-election interest rate situation. But you're exactly right. This Future Made in Australia policy, which is really their grand vision, their pitch to the Australian public for an economic plan for the next term of government, is all about government spending, redirecting resources from other industries towards the industries they want to see develop, such as green energy, advanced manufacturing, as we saw with the quantum computing. And of course, that is government spending. And that, of course, all else being equal, will be inflationary. And I think this highlights something very important, is that we are now in an inflationary world after a decade or more of being in a disinflationary world. So this government plan, plus what they're doing in the short term ahead of the election, I think is very risky. We'll obviously see tomorrow night, but I don't see anything in this that the RBA will be looking at to think they can cut rates anytime soon.
There you go. Warren Hogan with us tomorrow in the federal budget from Canberra. Many thanks for your time today.
Thanks, Ross.